Hello and welcome. Today, let's delve into the world of e-commerce and taxes, specifically focusing on TDS and TCS for e-commerce sellers, also known as e-commerce participants. If you are new to e-commerce or you run an online store and want to know how these TDS and TCS provisions would affect your e-commerce business, or simply curious, this video can help you have a basic understanding of these provisions and its implications on e-commerce businesses. While TDS is applicable as per income tax law, TCS is levied as per GST law. And in today's video, we are going to cover both these concepts in detail. Let's start from the basics and understand the meaning of e-commerce. Electronic commerce or e-commerce is supply of goods or services over a digital platform. This can include supply of goods like groceries, apparels, gadgets, etc. Services like passenger transportation, hotel accommodation, restaurant, housekeeping, etc. An e-commerce operator here is the person who owns, operates or manages this digital platform. Some of the e-commerce operators are BigBasket, Flipkart, JioMart, Amazon, Ola, Oyo, Urban Company, Swiggy, Zomato and so on. An e-commerce seller or e-commerce participant is the person resident in India supplying goods or services through this digital platform. This can be any business in India supplying goods or services to consumers, say through Amazon. So this does not include non-resident sellers. For instance, if you buy vegetables from BigBasket, BigBasket is the e-commerce operator and the shop seller, that is the person selling vegetables, is the e-commerce seller. Or if you book a cab using Ola app, Ola is the e-commerce operator and the cab driver is the e-commerce seller. Or if you order pizza through Swiggy, Swiggy is the e-commerce operator and Pizza Hut is the e-commerce seller and so on. Before we talk about taxes, let's first understand a bit more about e-commerce businesses, starting with business model. This can be either inventory based or marketplace based. In inventory based model, suppliers sell directly to consumers through their own platform. Brands like Bata, Soch or Van Heusen sell through their offline store. In addition to that, they also sell online on their own website where consumers can directly buy from. But in marketplace-based model, suppliers are required to list goods or services on a platform provided by the e-commerce operator. So the e-commerce operator here is the facilitator or the intermediary between suppliers and customers. If you have listed your business on platforms like BigBasket, Amazon, Swiggy, Urban Company, Ola, etc., then you follow marketplace-based model. Taxes that we are discussing today, these provisions are not applicable for inventory-based model. To put it differently, these are applicable only for businesses following marketplace-based model, and e-commerce businesses which follow this model can be broadly classified into 4 different categories. 1. Goods, that is e-commerce business supplying goods. Then online advertisement services. 3. Specified services. This can further be classified into 4 different subcategories. 1. Passenger transportation on platforms like Ola, Uber, restaurant services on Swiggy, Zomato, accommodation on Oyo, and housekeeping on Urban Company. Let's include rest of the services and call this category as other services. When it comes to taxation, provisions vary for each of these categories. So for easy understanding and also not to confuse you, in today's video we are going to focus only on the first category. So TDS and TCS provisions that we are going to discuss today is applicable only for the first category, that is e-commerce businesses which are into supply of goods. With this basic understanding, let's now see how a typical e-commerce sale happens. Imagine you are a seller who is also a GST registered person. Now if you want to supply goods, then you have to list on the e-commerce platform. Once you do that, the buyer places order and you supply goods. The buyer makes payment directly to the e-commerce operator, which is then transferred to your account. But before this transfer, the e-commerce operator makes several deductions. 1. Sales return. That is, if any product is returned by consumers, then the value to that extent would be deducted. 2. For being the facilitator, the e-commerce operator charges commission. That would be second deduction. 3. the e-commerce operator is required to collect tax called TCS as per GST law. 4. The e-commerce operator is also required to deduct tax called TDS as per income tax law. Now this deduction 3 and 4 are to comply with taxation provisions. After all these deductions, assuming there are no more deductions, the balance would be credited to your account. Let's first talk about TCS. The e-commerce operator is required to collect tax called TCS at 1% of net value of taxable supplies. That means TCS is applicable only on taxable supplies, so no TCS on exempt supplies. So if you are into supply of vegetables, fruits, etc., no TCS for you. Then net value here is gross sales as reduced by sales return. 3. There is no threshold limit. That is, irrespective of the value of the supply, the e-commerce operator is required to collect this tax called TCS. To have a better understanding of this, let's consider a scenario. Imagine you are a GST registered business who is into supply of groceries through your offline store. Let's say you are also registered on Big Basket as an e-commerce seller. And for April 2024, gross sales 10 lakh, sales return 1 lakh. So TCS is applicable at 1% of net sales, that is on 9 lakh. So TCS is 9K. Big Basket is required to deposit this 9K with the government within 10th of the subsequent month, that is by 10th May 2024, and also file GST return in form GSTR 8. Once this is done, TCS credit would appear in your GSTR 2A. GSTR 2A is a statement of input tax credit, and eventually in your electronic cash ledger. And this balance can be used to pay GST or any other liability, and if you have no other liability, you can claim refund. This was about TCS. Now let's talk about TDS. E-commerce operator is also required to deduct tax called TDS at 1% on gross supplies. Unlike TCS, where tax is collected on net supplies, rate of tax is 1% for both TCS and TDS. But if you have no PAN or Aadhaar, then rate of TDS is 5% instead of 1%. Let's understand this with the same example where we calculated TCS. Now let's calculate TDS. Let's say you have a valid PAN. So TDS at 1% is applicable on gross sales, that is 10 lakh. So TDS is 10K. But if you have no PAN, then rate of TDS would be 5% of 10 lakh, which is 50K. So if you want to avoid this, PAN or Aadhaar is must for you. And this 10K TDS has to be deposited by Big Basket by 7th of the subsequent month, except for March when the last date is 30th April. And also file TDS return in form 26Q. Once this happens, TDS credit would appear in AIS or 26AS, and you can use this credit to either adjust against any other tax liability, and if you have no liability, then you can claim refund when you file your ITR. But this TDS provision has one exception. That is, if you are an individual or if you run a proprietorship concern and if your gross supplies for the previous year is up to 5 lakh and if you have PAN or Aadhaar, then no TDS for you. But if you have no PAN or Aadhaar, then even though your gross supplies during the previous year is up to 5 lakh, TDS at 5% would be applicable. So you need to remember this exception. Now let's understand how both TDS and TCS provisions would affect your net receivables. Again, let's consider the same Big Basket example, but let's change gross sales to 30 lakh, sales return to 3 lakh. So net sales, that is difference between these two, is 27 lakh. And we know TCS is applicable at 1% on net sales, that is 1% of 27 lakh is 27K, and TDS at 1% on gross sales, that is 1% of 30 lakh is 30K. And let's say Big Basket charges 10% commission on net sales. So 10% of 27 lakh is 2.7 lakh, and let's assume the rate of GST is 18%. Let's now see, after all the deductions, how much would you get from Big Basket. Gross sales 30 lakh. Let's add GST at 18%, 5.4 lakh, so total is 35.4 lakh. Sales return 3 lakh plus GST at 18%, 54K, so total is 3 lakh 54,000. That's your first deduction. Then TDS 30K and TCS 27K, these are your second and third deductions. Then commission at 10% would be 2.7 lakh. GST at 18%, 48,600. So total is 3,18,600. That is your fourth deduction. After all these deductions, the balance 28,10,400 would be credited to your account. From this example, there are 4 key takeaways. One, GST that you pay on commission is your input tax credit, that is 48,600. So GST liability for April, assuming you have no other transaction, would be your net GST as reduced by TCS and input tax credit. So it is 4,10,400. Third point, remember you have a TDS credit of 30K, which you can use it to adjust against any liability that you may have in income tax law, and if you have no liability, then you can claim refund. 4. Whenever you pay commission, you have to deduct TDS under section 194H of Income Tax Act. But in case of e-commerce operations, provisions of 194H is not applicable because TDS is already taken care by the e-commerce operator. This is how both TDS and TCS are applicable on the same transaction. So you must be now wondering why both TDS and TCS on the same transaction. This is because 1, to help identify tax evasion, 2, to enlarge tax base, that is to bring in more and more e-commerce sellers to the tax net. Now, how does this happen? Let's understand. We know that TDS is collected as per income tax law and TCS as per CGST Act. But what if you are not GST registered? No TCS for you. This is when TDS comes to the rescue of the government. Because TDS is applicable whether or not you are GST registered. The only exception is turnover, that is up to 5 lakh, to help small taxpayers. So either through TCS or TDS, the government can easily identify defaulters. So e-commerce operators are forced to declare their income in their ITR or file GST returns. This is how tax base can be widened. Also, there is a data sharing arrangement between income tax and GST department. So whenever there is a mismatch between your ITR and GST returns, or let's say you have declared income in your ITR but you are not registered in GST law when you are actually required to do so, such activities can raise red flag about potential tax evasion. So eventually you end up receiving notices from either or both the departments. And if you want to avoid this, ensure that you declare correct income and apply for GST registration once you cross the threshold or wherever applicable, so that you can reduce the chances of receiving these notices to some extent. If you want to know more about GST registration and these threshold limits, I have a separate video on this topic. If you would like to know more about it, you may consider watching it. The link is in the top right corner. Also, remember, ignorance of the law is no excuse. So, there you have it. Hope the video was informative. Thank you for watching.